So, Asad, I know in your presentation you've addressed this thing about who all should invest in derivatives, and you've said that nearly everyone, or rather everyone, can and probably should invest in derivatives for various reasons. But I have to ask you this again: should individual investors, or what is commonly referred to as the retail investor, be putting in money in derivatives?
I think it's derivatives. Like I said, I've gone through the benefits of using it and the diversification benefits, etc. And I think the derivatives market are actually designed so that retail investors can use it. If you look at, for example, the currency contracts that are out there, the margin requirements are extremely low, and this is so that individual investors can use it. And even with commodity markets, we have mini contracts, for example, like on gold, which allow retail investors who don't necessarily have as much money as institutional investors to also invest in it. And I would say, in that sense, it is designed to be used by retail investors as well as institutional investors. But more importantly, people who are interested in it and people who are willing to take the time to understand the markets and understand the products can really do well out of investing using derivatives.
But commonly when people talk of derivatives, they usually talk of it in purely very speculative terms. It's either you double your money or you lose it all. So when it comes to the real risk of investing in derivatives, could you talk a little bit more about that? And also, I think the very important question that is linked to that is, how large can the losses be?
Okay, sure. So, like you said, in derivatives you can have 100% gain or 100% loss. But it's important to put these numbers into perspective a bit, because let's say, for example, you have a stock that costs you 100, okay? And 1 year from now it's either going to be 110 or 90. So you'll have a 10% gain or a 10% loss. You can have a future in the stock, for example, which costs you nothing, and in the next year it'll be worth, you'll make 10 or you lose 10, right? So in that sense you might have a really high percentage gain or loss, but because the numbers are so much smaller that you're having to invest, it's no different from, say, putting a lot of money into a stock. So from that point of view, the losses, in terms of how large can they be, they're as large as you allow them to be. So, you can put a stop loss in at any point. You always have control over how much you are risking. So as long as you do things the right way, you'll always know in advance how much you can lose. You'll always be able to control your losses. And, they can be as, they will not be larger than anything else as long as you treat it in the right way.
Yeah. You've mentioned stop loss here. And can you talk a little bit more about that? Because I think that seems to be something which, if used well, could actually help you capitalize on the derivative opportunity. But if you are not really taking care of that side of it, you could lose a ton of money.
I would say, let's go through what a stop loss is. Essentially, it's what we do is, if we buy something, say we buy a rupee at 45. We can put a stop loss at 43, so that if the rate falls below 43, then we make a loss, right? So the importance of a stop loss is that we want to protect our capital. So we want to protect ourselves from making very large losses. And when a price hits a stop loss, we are essentially saying to ourselves, you know what, we made a bad trade, so let's just take the loss and move on, rather than hoping that it will turn around and come back. So it's very important to have a stop loss, because then you know exactly how much capital you are risking on each trade. So going back to your earlier question of how large can the losses be, well, if you put a stop loss in place, then you will know exactly how large the maximum loss will be. And to further extend on that, I would say that stop losses are fairly important for when you're making investments that are, say, where you have a time frame of, say, 1 month, 2 months, or 3 months. Not as much when you're making a very long-term investment. In that case, you need to invest more money and be able to weather the storms a bit better.